Well, for more on the broader markets, joining us now is David Dietze, Managing Principal and Senior Portfolio Strategist at Peapack Private Wealth Management. David, thanks so much for joining us.
A pleasure to be with you, Jacqueline.
So what have you been hearing from Fed speakers lately that has jumped out to you? Because, you know, it's headline grabbing. Is it significant in terms of the messaging?
Yeah, absolutely. So, I mean, we need to go back to the discussion by Fed Chair Powell right after the recent Fed confab, where basically the takeaway was a degree of dovishness, saying that, you know, we need to be very conscious of the amount of rate hikes that have not been reflected in the economy, and that although we're multi-directional here, we seem to see a strong economy, yet inflation moving in the right direction. Well, then, of course, the next step was the market took off. We had one of the best weeks last week in a long time, with that S&P 500 up about 5.8%, Russell 2000 even more. And this week, of course, starting with cash carry, there's starting to be pushbacks. The last thing the Fed wants is the financial market to get ahead of themselves, which could actually accelerate some consumer spending and make their job much more difficult should they have to have another rate hike and then have the market, of course, pull back very, very sharply. So what we're seeing now, I think, is a little pushback on the bond market getting so exuberant here. But there's really no new data that they're working from. In fact, the latest data was, of course, with the October jobs report showed a slowing of job creation, a slightly tick up in the unemployment rates. I do think that the economy is in a slowing mode, which is positive in terms of keeping interest rates, inflation down.
How much of an upside risk do you see to inflation at this point?
So, you know, I think probably risk one could be from the geopolitical theater. If something were to really exacerbate what's going on in the Middle East. So, for example, if somehow Iran got dragged in, we retaliated with embargoes, Iran then cut off the Straits of Hormuz, where 30% of all the globe's energy passes through daily, you know, energy prices would skyrocket. That would be a big negative for inflation. Of course, the other thing is wages. We have seen, of course, a record settlement by the UAW with the so-called Big Three. To what degree are other workers around the country looking at that and saying, where's ours too? Indeed, we've seen Toyota, who's not generally unionized, offering its workers a greater amount.
Yeah, no, it's interesting that it just seems like there's a, you know, strike after strike in the U.S., also here in Canada as well, and workers being able to negotiate and win some, you know, big concessions from their employers. I wonder, a couple of other companies that are in the news today, WeWork is one of them, filing for bankruptcy protection. I wonder if this is, from your perspective, a WeWork story. You know, it's because of, you know, it's WeWork limited to the company itself, or is this also about the office space sector, or is it something greater, you know, to do with the broader economy?
Well, as usual, it's a little bit of both. But I mean, certainly the fact that they announced their bankruptcy today, and we've seen really very positive action in the market, suggests that it doesn't have any kind of systemic implications. I think the main story here is really threefold. The first one is if you pay too much, and that's clearly what Mr. Newman was doing while he was still with the company, and is the legacy of WeWork, paying too much to get these trophy properties without any guarantee that they would be able to continue to offer these very short-term rentals at a price that would cover all their expenses. You're going to be in trouble. That's no matter what business you're in. Of course, the other key theme here is that we're using less commercial office space. Due to the pandemic, we have all these tools. People realize you can be very productive working from home. So the demand for commercial real estate has gone, is much lower. And of course, that hurt the demand side of their equation. People talk about higher interest rates hurting them, but the fact of the matter is many of these leases they entered into when interest rates are still low. And finally, it's a capitalist free market system. Some companies go under. This was well known. They had problems for many, many months. I think people are saying, it's interesting, but it's not going to affect my portfolio management.
I want to switch gears to another topic, another company, but Chevron is one of your picks. But Warren Buffett was recently mentioning that he's been paring back his holdings of Chevron. So what do you see in Chevron that Warren Buffett isn't seeing in this moment?
Well, I mean, Warren Buffett, I think, likes fossil fuels. Look at his huge holdings in Occidental. You could argue that he's just moving from Chevron to Occidental and not really exiting the entire area. What I like about Chevron here is very low debt, $15 billion. It's probably your second biggest integrated energy company on the planet. A long track record, dividend aristocrat of returning money to shareholders, increasing that dividend more than 25 years in a row, plus, of course, buying back close to 7-8% of the company every year via stock buybacks. So why is there the opportunity? Well, the stock's down about 20% this year. We've seen energy pull back since last summer, but I think just as importantly, they missed their third quarter report. You don't want to do that in kind of a dicey earnings season. They had some delays in the Kazakhstan. We don't think that says anything long-term about the company. And the bigger issue is the $60 billion acquisition of Hess. What does that do for them? The negative, of course, is that it's going to cause them to have to pay their rich dividend to all the Hess shareholders because they're taking stock. There's no real overlap between the companies, and so therefore there's no real cost cutting. But I still like it because, of course, it gives them a 30% stake in that very rich Guyana field right off of northern South America. And I think from an energy investor's point of view, that plus Exxon's acquisition of Pioneer shows that the energy companies themselves feel that any short-term transition to a greener world is going to be many years in the offing, A. B, it's cheaper to drill, so to speak, on Wall Street. The valuations are so low here that they are better off buying other companies as opposed to doing the drilling themselves. So we like with Chevron down 20% this year, great dividend, disciplined management. We think for the long haul this is good. And of course, if the geopolitical concerns come back in with full force, inflation also, Chevron's where you want to be.